Welcome back to the Deep Dive. We are jumping right in today looking at the seismic activity around Ross Stores. Ticker is ROST.
Yeah, that Q3 earnings release on November 20th, it really sent some shockwaves.
It really did. So our mission today is to unpack what happened. We want to get into the drivers behind this, just massive beat, figure out what happened to the tariff headwind that everyone was worried about.
And why the market reacted so strongly. I mean, this wasn't just a good quarter. It was, a statement quarter for off-price retail.
Absolutely. So just to set the stage, we're talking about the 13 weeks that ended on November 1st. That's their fiscal Q3 for 2025.
Okay, let's start with the snapshot, the numbers. On the profit side, the official GAAP diluted EPS came in at $1.58.
$1.58. And the street was looking for what, around $1.42?
Exactly, about $1.42. So that's an 11% beat on earnings per share right out of the gate.
And what's really wild about that number, that 158, is that it includes a hit.
It does. Management was really clear. They absorbed a 5-cent per share headwind from tariffs in the quarter.
So we do the quick math. Their core operational earnings were closer to 163. It just shows you the underlying strength.
The leverage was incredible. And you saw it on the top line, too. Total revenue hit $5.6 billion.
Which is a 10.4% jump over last year.
Yeah, a huge jump. It sailed past what the analysts were expecting by 3, maybe 4%.
But the number,
yeah,
the one number that really stopped everyone in their tracks was the comp sales figure.
Oh, yeah. Comparable store sales.
Yeah.
The market was basically penciling in a solid, 3, maybe 3.5% growth.
Which would have been good.
It would have been fine. But they delivered a positive 7%.
7. They basically doubled the high end of expectations.
When a company of this size and, maturity puts up a 4-point surprise on comps, it tells you something bigger is going on. It's not just a good quarter. It feels like a structural shift.
Right. It feels like their whole value proposition is just clicking with this consumer trade-down waves we're seeing. The market reaction was instant. You could tell the big money was caught completely off guard by this.
For sure.
Okay, so phenomenal top line. But how did that translate to the bottom line? Let's talk about margins and efficiency, especially with costs being so high everywhere.
That's the critical question, right? A big comp can hide a lot of sins, but here it really didn't have to. The operating margin was 11.6%.
11.6. How does that compare?
Well, what's interesting is that it's basically flat with last year, but it absolutely crushed the consensus estimate, which was down at 10.6%.
So they beat the street's margin expectation by a full percentage point, 100 basis points.
100 basis points. I mean, on billions in revenue, that is a massive amount of money.
And what's so impressive is how they held that 11.6% line, because they were dealing with some pretty serious cost pressures internally.
They absolutely were. Management walked through a few of them. Distribution costs were a big one.
So getting products to the stores.
Exactly. That was up about 60 basis points, mostly because they're ramping up a new distribution center, which is always expensive at first. And they still had some lingering costs from handling all that tariffed merchandise.
Okay, so 60 basis points of pressure there. And then merch margin was down a little bit too.
Just slightly. Down about 10 basis points. So a tiny dip in the profit they make on each item. But you add that up, and they absorbed about 70 basis points of core cost pressure.
Plus the tariff hit.
Plus the 5-cent tariff hit, and
Right.
They still beat the operating margin expectation by a full point. That's the power of sales leverage.
Right. It's that classic SG&A story. Your sales are up 10%, but your fixed costs, your selling general and admin expenses are only up a few points. That's where the profit comes from.
That's the whole model. And you can see that strength on their balance sheet. It's just a fortress. They're sitting on about $4.1 billion in cash.
And their long-term debt is only, what, $1 billion?
Just $1 billion. They are just gushing cash. Free cash flow margin shot up to 11% this quarter.
Wow, up from like 6.6% a year ago.
It's a huge acceleration.
Right.
And they're putting that cash to work. They bought back $262 million worth of stock in Q3 alone.
They're on track for that $1.05 billion in buybacks for the year.
They are. It just reinforces that this is a long-term compounder, not just some one-quarter wonder.
Okay, so let's get into the engine room. What was the secret sauce behind that incredible 7% comp number?
Well, the best part is that it was broad-based. It wasn't just one hot category. The 7% gain came from both higher transactions.
Meaning more traffic, more people in the stores.
Right. And a bigger average basket size, the AUR.
So more people are coming in, and when they do, they're buying more stuff. Which one was the bigger piece of that?
Traffic was the bigger driver, and that just confirms how powerful that off-price value proposition is right now. It's a validation of their whole thesis.
And you have to put that in the context of, things like S&AP benefits being reduced and just general pressure on that lower income household.
It makes off-price almost mandatory, not just a choice. But the real internal catalyst, the thing they kept pointing to, was the success of their branded strategy.
Let's talk about that because that feels like a huge piece of this. They specifically called out ladies' apparel.
Yes, ladies' apparel. It accelerated this quarter and actually comped above the chain average.
That's a massive turnaround. That category has been a drag for them in the past, hasn't it?
It has, often flat, sometimes even down. The fact that it's now leading the charge tells you that their buyers, their merchants are just winning. They're getting better brands, better inventory.
So this branded strategy isn't just about finding cheap clothes. It's about securing better quality, recognizable brands across all their price tiers. Good, better, and best.
Exactly. They are dominating the closeout market. And when a shopper sees a brand they recognize at a Ross price, it drives them into the store and it makes them feel like they're getting an even better deal, which is why that average basket is also up.
It's a virtuous cycle.
It really is.
And what about marketing? They talked about some new campaigns trying to reach a younger customer. Do they just throw a bunch of money at that?
See, that's the really disciplined part. No. They got higher engagement, more traffic, without increasing their marketing spend as a percentage of sales.
So a more efficient spend. A higher ROI on the dollars they were already planning to use.
An efficiency win, not a spending win. It's classic Ross.
And they're still expanding the store footprint, right?
Yep. They finished their 90-store plan for 2025. And they made a point of saying that the new stores, especially in places like the New York metro area and Puerto Rico, are actually doing better than planned.
That's a great sign. It means the model still has legs, even in new markets.
For sure. And they also mentioned all the little things, store refreshes, faster checkouts. They said it's very early days for that stuff.
Which is just management speak for we have even more levers to pull down the road.
Exactly.
All right, let's get to the elephant in the room. The thing that has been hanging over all of retail for years. Tariffs.
This, to me, was the single biggest piece of news on the call. This is what really justified that huge stock move.
What did they say?
They basically declared victory. They now expect the cost impact from tariffs in Q4, the holiday quarter, to be negligible.
Negligible, as in close to zero.
Pretty much zero. Gone. That is a massive, massive change from what the market was bracing for.
How did they pull that off so fast?
It was a full court press. They pushed their vendors for cost concessions. They moved sourcing to different countries. And because that branded strategy was working so well, they were finding amazing closeout deals that were already, priced post-tariff.
So they basically solved the problem. And that limited the full year headwind to only about 15 or 16 cents a share.
Much, much lower than feared. And so you take that operational momentum, the 7% comp, and you combine it with the biggest financial uncertainty just vanishing. And that gave them the confidence to raise their guidance.
And they raised it big time.
Oh, yeah. For the full year, they took the EPS outlook up to a range of 638 to 646. That's up from like 608 to 621 before.
That's a huge jump. And they bumped the Q4 comp guidance too.
They did, up to a positive 3 to 4% from 2 to 3% previously. For this company, guiding to 3 or 4% comps in the holiday quarter is actually really, really confident.
So no surprise the analysts were falling all over themselves after the call. We saw a ton of buy ratings reiterated, price targets getting jacked up. A lot of them are pointing to $200 now.
Which brings us to the main risk now, which is just valuation. The stock is not cheap anymore. It's trading at a premium.
So to justify those $200 price targets, they have to keep this up. They have to keep delivering.
The bar is officially raised. They need to prove this wasn't just a one-time thing.
Okay, that is the perfect setup for our next segment. We acknowledge the stock has had a monster run, so just buying it might feel a little late. We're going to pitch an outrageous but plausible trade idea for someone who thinks this story has even more room to run.
And we have to say it. This is not financial advice. We are just exploring the mechanics of a super bullish trade, given what the analysts are now saying.
Not advice, for informational and entertainment purposes only. So with the stock already flying, we're looking way out on the calendar. We're looking at the January 2026 options chain.
A year out. And the pitch here is a long-dated, high-strike bull call spread.
Let's break that down. It's basically a defined risk bet that the stock will go up a lot. You're capping your potential profit, but you're also capping your maximum loss. It's a capital-efficient way to play for a big move.
Right. And the trade is essentially betting that the stock will blow past that $200 level over the next year. And the rationale is that this branded strategy and the new marketing, they're just getting started.
The idea is that as they anniversary these strong results, the margins will expand even further in 2026.
And there are two key catalysts that would make this trade work. First, those new stores in the Northeast keep outperforming. That proves the growth story isn't over.
And second,
The complete stabilization of margins now that the tariff drag is gone. If that headwind is truly a thing of the past, they could probably sustain comps in the 4 to 5% range.
which is still great for them.
It's fantastic. And if they can do that, they can pretty easily convert it into that consistent double-digit EPS growth the market now demands.
And if they do that, then those $200 analyst targets start to look pretty reasonable. That's the bet.
Again, just an idea to illustrate the bull case. Please do your own research.
Okay, so let's wrap this up. The core takeaway from the Ross Stores Q3 call: it was just a masterclass. They took a tough environment and turned it into a huge operational win. And they solved the tariff problem way faster than anyone thought possible.
It really confirms their spot as a top-tier compounder in the retail space. The team just showed incredible agility. That turnaround in ladies' apparel is a case study in good merchandising.
Which brings us to our final provocative thought for you to chew on. Management made it crystal clear. They achieved all of this: the traffic, the new customers. They did it all without increasing their marketing budget as a percentage of sales.
And that's the big question for next year. They've now seen what a modernized marketing campaign can do. They have proof of a positive ROI. So do they break their old conservative model?
Do they actually decide to press their advantage and significantly increase that marketing spend next year to try and accelerate growth even further? Or do they stick to the playbook they've used for decades, which is all about maximizing margin and cash flow?
The path they choose, leaning into growth or leaning into margin, will tell you everything you need to know about their strategy for the next few years.
One thing's for sure: the consumer trade down is real, and Ross is in the driver's seat. Thanks for joining us for this deep dive.